After studying this module, you shall be able to understand some of the key objectives of monetary policy, learn about major changes in the monetary policy framework in the Indian context, learn about the effectiveness of various channels of monetary transmission in the Indian context, understand the role of interest rates in the Indian economy, know how exchange rates affect inflation and interest rates in India, understand the role of banks in monetary transmission in the Indian context. In this module, we examine the objectives of monetary policy and the evolution of monetary policy in India. In this context, we examine the role of Reserve Bank of India, India's central bank, the institution responsible for framing monetary policy. We will see that the RBI has made a long journey and its monetary policy instruments as well as operating policy targets have changed over the years. The RBI started monetary targeting in late 1980s and later in 1999 adopted a multiple indicator approach. Thereafter, in 2011, it adopted call money rates as the operating target in line with the US Federal Reserve, that is the Central Bank of USA, and other advanced economies. In what follows, first we try to provide an overview of the evolution of monetary policy framework in India and trace changes in it in response to developments in the domestic and global economies. Thereafter, we also analyze the evidence on various channels of monetary transmission in the Indian context. So, in this perspective, let us first discuss about the objectives of monetary policy. Monetary policy, an important component of macroeconomic policy, is framed by central bank of a country. The creation of the US Fed, that is Federal Reserve Bank, in 1913 is an important milestone in the history of central banking. In India, the Reserve Bank of India, that is RBI, is the institution responsible for framing monetary policy. The objectives of monetary policy have varied both geospatially and over time. The primary objective have been achieving full employment and maintain requisite economic growth along with stable prices. Milton Friedman has argued that rather than targeting growth, the primary focus of monetary policy should be to maintain stable prices. Note that stable prices in this case refer to a fixed rate of rise in prices and that price stability is not equivalent to zero inflation. Rather, price stability refers to a low and stable rate of inflation. It is widely believed that both high inflation as well as deflation impose significant cost to the economy. In fact, maintaining stable and low rates of inflation, known as inflation targeting, has been adopted as an operating target by many central banks across globe, and it has also been adopted by RBI recently. In emerging economies like India, which are experiencing structural changes, the appropriate level of stable inflation is a bit higher than in advanced economies, where it's around 2%. Inflation targeting has faced a lot of criticism in the aftermath of the recent financial crisis, as such policies lower aggregate demand at a time when the economy is already in recession. Based on recent US experience, one can argue that low inflation and growth does not necessarily bring financial stability, and speculative bubbles can develop despite low inflation and growth. It is being said that financial stability should also be one of the objectives of central banks and that macroprudential regulations can be an important policy instrument in their hand. Now let us look at the objectives of the Reserve Bank of India. In the Indian context, the objective of central bank is outlined in the preamble of Reserve Bank of India Act 1934. It envisages that the role of the RBI is regulate the issue of banknotes and keep reserve with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. Based on this mandate, the RBI has tried to maintain stable prices and tried to ensure that credit demands of the productive sector are fully met. The emphasis of RBI on these two objectives has varied over time. Recent evidence suggests that currently the RBI is laying relatively greater emphasis on the goal of achieving price stability. In 1985, the landmark Chakravarti Committee report on the working of the monetary system had defined an inflation rate of 4% per annum as a tolerable level of India. Indeed, it is believed that a rate of inflation between 4 to 5% lies in the comfort zone of RBI. India had a relatively closed economy till the 1980s, after which trade liberalization and exchange reforms were introduced in a phased manner to begin with and at a more rapid pace since the early 90s. Opening of the economy has led to volatility in exchange rate because of volatile capital flows. In this context, RBI intervenes time and again to maintain exchange rate stability. This is an important role it plays as exchange rates have spillover effects that can jeopardize the achievement of RBI's mandated objectives. For example, as you have already studied in previous modules, a country can experience rapid inflation due to sharp depreciation of currency. Now, let us look at evolution of monetary policy in India. Reserve Bank of India has made a long journey and its policy framework has evolved over time. Prior to 1991, before liberalization was adopted, the role of the RBI was largely confined to monetization of fiscal deficit and maintaining a regulated interest rate. The RBI now has much greater autonomy in formulating monetary policy. As you have already read in the previous modules, with economic reforms, now there are limits on government debt and interest rates, and exchange rates are largely market determined. As such, the RBI plays an important role as it uses the policy rate to influence the lending rate and also tries to maintain the currency stability. The RBI was set up in 1935 for a snapshot of its operations in the pre-independence era refers to Ray 2013. After independence, especially from 1951 till about 1970, the main role of the RBI was to support the government's planned expenditure via deficit financing. During this period, the Mahalanobis plan, that is the second 5-year plan, focused on large-scale public sector investments in the industrial sector, and this required huge public expenditure, much of which had to be financed by borrowings from the central bank. With industrialization underway, it was expected that the prices of wage goods would start rising. So, the RBI's role was to focus on selective credit control to check inflation, while ensuring flow of credit to the priority sectors. The bank rate, that is the rate at which the commercial banks borrow from RBI, was raised frequently during this period. During 1971 till about the mid-1980s, RBI's focus shifted to credit planning. During this period, the public sector played an important role in the economy and the fiscal policy dominated monetary policy. And there was an increase in the statutory liquidity ratio, that is the SLR, which is defined as the percentage of assets that banks have to hold in the form of government securities to raise resources for the government through the banking system. The cash reserve ratio, or the CRR was also periodically raised during the period to curb the inflationary pressures arising from huge deficit financing. Ever-rising fiscal deficit and inflation in the 1980s saw the adoption of monetary targeting framework based on the recommendations of the Sukumai Chakravarti Committee in 1985. The Chakravarti Committee found excessive monetary growth as a reason for surge in inflation. Under the new framework, reserve proposed by the committee, reserve money was to be used as an operating target and the broad money, that is M3, as an intermediate target. Structural reforms and financial liberalization in the 1990s led to a shift in the financing paradigm for the government and commercial sectors with increasingly market-determined interest and exchange rates. The role of the RBI also underwent a change alongside. Several important development steps were taken to curb the monetization of fiscal deficit. For example, the creation of ad hoc treasury bills was limited and then completely phased out by 1997. However, monetization continued even after cessation of ad hoc treasury bills as RBI continued to subscribe to the primary issue of public debt in auctions. Finally, with implementation of FRBM Act in 2003, RBI was not allowed to subscribe to the primary issues starting from April 2006. Market borrowing as a fraction of fiscal deficit rose sharply after that. Currently, most of the fiscal deficit is financed through market borrowing. This was an important breakthrough in reducing fiscal dominance over monetary policy. With the opening of economy in 1990s, foreign assets became an important component of reserve money. Since international financial flows were quite volatile, monetary targeting became difficult to achieve. Volatility of foreign exchange flows made liquid management an important concern of the RBI, as foreign exchange inflows led to an increase while outflows lead to decrease in liquidity. In light of this, in 1999, the RBI moved to a multiple indicator approach in which the formulation of monetary policy was based on a large host of macroeconomic indicators. So, the interim liquidity adjustment facility, that is ILAF, was introduced in April 1999, which finally became liquidity adjustment facility, that is LAF, with greater openness to trade and capital flows and emphasis on fiscal consolidation. The earlier tools of CRR and SLR became far less important as they were no longer effective for managing liquidity. Another important change introduced at this time was the emergence of the repo and reserve repo rates as the primary policy interest rates of RBI. A market stabilization scheme, that is MSS, was introduced in April 2004. Under MSS, Government of India securities of less than 2-year maturity and treasury bills were being used for sterilization of foreign exchange flows. This greatly reduced the pressure on LAF. Also, the issuance of securities under the MSS enabled the Reserve Bank to improve liquidity management in the system, and it brought stability in the foreign exchange market. A few problems arose with the process of LAF. First, although RBI was sucking liquidity at a single reverse repo rate, it was injecting liquidity using multiple rates, viz. Bank rate and the repo rate. This implies that there was a floor of interest rate but no ceiling. Second, there was no unique policy rate. In a surplus liquidity condition, the policy rate was the reverse repo rate. While In a liquidity deficit situation, it was the repo rate. There was no firm corridor, that is, gap between repo and reverse repo, and the call money rate remained outside this corridor most of the time. It was higher than repo in liquidity deficit conditions and lower than reverse repo in surplus liquidity conditions. To overcome the problems with the LAF system, a new LAF framework was introduced. First, the weighted average call money rate was unambiguously adopted as the operational target. Second, the repo rate was made the only independently varying policy rate. Third, a new marginal standing facility, that is MSF, was instituted. The corresponding rate being known as MSF rate. Under MSF, commercial banks, SCBs, could borrow up to 1% of their net demand and time liabilities, that is NDTL, at a rate above the repo rate. Under the new scheme, a corridor system was put in place with the MSF rate at the upper limit, the reverse repo at bottom and repo in the middle. The width of the corridor was decided as 200 basis points. However, the width of the corridor was varied with changing economic conditions. With the introduction of new LAF, RBI's control over call money rate has increased and call money rate has been adopted largely within the corridor, even in liquidity deficit conditions. The new operating framework with call money targeting implies an important role for interest rate transmission. This implies that change in policy rate passes through call money to the spectrum of interest rates. However, there are challenges. For instance, the pass through from the policy rate to call money and other rates depends upon liquidity in the system. Evidence suggests that such pass through is more evident in liquidity deficit phase as compared to the liquidity surplus phase. Now let us find the evidence on monetary transmission in India. The relationship between money, output and prices has been extensively analyzed in India and the evidence is a mixed one. Some studies find that monetary policy affects both output and prices, with the impact on prices being higher than on output. However, it has also been argued that in India, monetary policy is not the appropriate tool for combating inflation, as some empirical studies have shown that the link between monetary tightening and inflation reduction is relatively weak, whereas the link between monetary tightening and reduction in GDP growth may be stronger. This could be because inflation in India is not a monetary phenomena, is largely a byproduct of supply side rigidities. So it has been argued that the RBI should be cautious in its approach towards inflation. A hawkish approach may do more harm than good to the economy, as it will decrease investment and may not affect inflation in the desired manner. In what follows, we review the empirical literature to see what it says on the strength and operation of various channels of monetary transmission in India. There is evidence on the existence of the interest rate, exchange rate, credit and asset price channels of transmission in the Indian context. You may recall each of these channels were discussed in detail in the previous module. So the first one is interest rate channel. It is also found that the interest rate transmission has become important, especially since the 1990s. An increase in the bank rate, that is monetary tightening, tends to have a negative impact on output, prices and exchange rates, whereas a positive shock to the broad money, that is monetary expansion, leads to the opposite effect on output and prices. Further, there is evidence to suggest that there is a asymmetry in the transmission, with tightening being transmitted relatively faster compared to easing. However, evidence in this regard is mixed, as some studies find little conclusive evidence to show that CRR and bank rate shocks affect the index of industrial production, that is IIP. At the same time, some studies suggest there is a growing importance of interest rate channel in Indian economy post-liberalization, with the CRR playing only a complementary role. Further, it is also found that aggregate demand responds to interest rate changes, although there is need to explore the lags in the effects of interest rates to fully understand the way it affects the economy. Some studies have found that the call money rate is significant for monetary transmission, and monetary tightening reduces the growth rate of GDP and of various components of GDP, for example, gross fixed capital formation and private consumption expenditure, etc. The decline in growth of GFCF matters in the long run, whereas the slowdown in the growth of PFCE affects aggregate demand in the short run. The second one is exchange rate channel. It has also been suggested that the interest rate channel in India is relatively weak, while the exchange rate channel is more dominant. It has been found that monetary tightening has negligible impact on the IIP and prices, while the depreciation of the rupee increases prices substantially. It has been found that a positive shock to the exchange rate, that is the depreciation of the rupee, increases both prices and output. The increase in prices can be explained through exchange rate pass-through, as depreciation makes imports costlier and much of the Indian imports like oil cannot be substituted domestically, thus raising the prices. Whereas output increases because depreciation renders Indian goods cheaper for foreigners, thus increasing exports. Rupee depreciation also leads to an increase in the interest rate. This could be policy induced, as central banks tend to intervene by raising the interest rate to attract foreign capital when the currency faces depreciation. We'll learn about this relation between exchange rates and interest rates in the earlier module. Further, it has also been argued that the interest rate does not affect price directly. Rather, it has an indirect impact via the exchange rate. The increase in interest rate leads to currency appreciation due to inflow of foreign exchange, and rupee appreciation in turn leads to decrease in prices. Thus, monetary transmission in India works on the lines of Japan and not the US, because India is still a country with relatively low levels of consumerism, especially bank borrowed consumerism. However, it has been argued that the interest rate certainly affects investment through Keynesian marginal efficiency of capital that we have already discussed in the previous modules. The third channel is bank lending channel. Empirical studies have also highlighted the importance of the bank lending channel, that is BLC, in India through operation of both CRR and the bank rate. The main empirical issue in this context is of identification, as the loan amount decreases after monetary targeting. The challenge is to distinguish whether the decrease is due to a fall in loan supply or because of a decrease in loan demand. In this context, considerable heterogeneity has been detected with respect to response of different banks. For example, private versus public banks, domestic versus foreign banks, small versus large banks behave in a different way. In particular, it is seen that big banks tend to reduce loans by a lesser amount in comparison to the smaller banks, as they have a wider resource base. Also, relatively more liquid banks reduce loans by less than less liquid banks. So far as foreign banks are concerned, the availability of external funding could be one reason they are able to insulate themselves from domestic monetary targeting. Overall, there is evidence to suggest that BLC is operative in India. Therefore, if the consolidation in the banking industry seen in recent years lead to creation of big banks, this may reduce the importance of bank lending channel of transmission. It has also been found that during tight monetary conditions, all banks behave in a similar way, but under easy money conditions, their behavior differs. So that there is some asymmetry in the operation of the BLC depending upon monetary conditions prevailing in the economy. Our discussion so far was based on several empirical studies carried out by various authors in the context of India. The results of these studies depend upon the time period chosen, the exact variable selected, and on the econometric techniques employed. What you should make out of this is there is still plenty of scope of further research in this area in the Indian context. Now let us summarize what we have learned from this module. The RBI plays an important role in framing monetary policy in India with economic reforms and the adoption of market determined interest and exchange rates. Its role in influencing macroeconomic variables has assumed greater importance. There is weak evidence to suggest that interest rates affect inflation, whereas effect on output is more certain in India. Therefore, it would be advisable to use interest rate to control inflation in a very cautious manner. Since pass-through of short-term rates to long-term rates is crucial for interest rate transmission, RBI should adopt measures to strengthen its control over long-term rates via short-term rates. The strength of transmission through the interest rate channel depends on several factors, particularly on liquidity conditions, as the pass-through from policy rates to the spectrum of interest rates is stronger in deficit conditions in comparison to the surplus conditions. The pass-through from policy rate to bank deposit and lending rate is another concern in case of India. Lending rates are affected more quickly with monetary tightening compared to the monetary easing. There is evidence to suggest significant exchange rate passes through in India. There is also evidence of operation of the bank lending channel in India.